Peter Rose, Longwood Currency Trading. Good morning. It is morning, middle of October of 2021. Forex position size versus bank size is what I'd like to chat with you today. I've had some people calling, well, they don't call me because they don't know my number, but emailing me, contacting me about how to size their position, how to calculate how many lots they can trade, and they see all this stuff on the web about position sizing being really critical in working their trades. And I think the reason for that, that you would look at position sizing as being an important thing to think about, is if you're trying to compound your trades. And let me swing this over here a little bit. I like that. Thank you. But I don't advocate compounding. I think that compounding is a wonderful thing. I think it was Einstein that said it's the eighth wonder of the world. But being eighth wonder of the world, it can also work radically against you if you really don't understand how to compound. I compound, but I compound totally differently than what anybody else does. I do it simply, and I do it to protect myself so that when things go really wrong, which they sometimes do, unless I've done something really stupid, I can get out of that with a minimal exposure to what's going on. So I think that position sizing concerns are relegated to if you're going to be compounding. And I think if you are going to compound, you might want to be a long-term trader as opposed to a day trader until you get really, really good. And then position sizing becomes really critical because you're basing the number of lots on how much money your bank will provide for you in order to trade. I approach it totally differently. I don't consider position sizing in anything that I do. My concern is the bank size. How much money do I have in my bank that I'm going to trade? And I consider those only in round numbers. So if I want to trade one full lot, which is $100,000 worth of currency, I'm going to need a $10,000 bank in order to do that. Now, you say, well, why would I need a $10,000 bank to trade currencies when I get 50 to 1 leverage, or whatever it is that you're getting? Well, in the United States and everywhere else too, you have a margin requirement, and that margin requirement in the U.S. is 5% of the value of the currency. So $100,000 is a full lot. You have to express those in terms of $100,000. So you got to take whatever the current price is and multiply that by 100,000. So if I was trading pound dollar, and the value of pound dollar at that time was 1.30000, okay? So because USD is the quote currency, pound dollar, the 1.30000 is in US dollars. So I have a position value. If I say, okay, I'm going to trade one full lot, I have a position value of $130,000 at 1.3000, right? So in the U.S., I need 5% of that as margin, or my ante into the game. That's what I got to have to get in. And that margin of 5% of $130,000 happens to be $6,500. So if I have $6,490, I cannot open one full lot position. I'd have to go in with 9 minis. Okay. I'm not an advocate of trading anything lower than a micro, than a mini, not a micro lot. So if you're trading one mini lot, for example, you're just getting started, and you don't have $650 in your bank, you've got $649, you can't open a mini lot, and you don't want to open a micro. if I look at that same situation where I've got $649 or $40, $640 or whatever it is, and I can't trade one full lot, you'd say, well, that's where position sizing comes in, Peter. Instead of trading one full lot, I could trade 9.3 minis. No, no, because that's position sizing, and that's complicated. If I don't have $6,500, I'm not going to trade one full lot. I mean, if that's where I'm at in my life, is that I'm trading full lots and not minis. So if I had, let's say I got $8,000 in my account, I could trade 8 minis, but I couldn't trade one full because I'd need 10 minis, $10,000 to trade a full, right? I mean, you get really picking hairs when you get close to that bridge between trading mini lots and full lots, or trading one full and 2 fulls, or one full and 10 full. It becomes complicated because that's position sizing. So I eliminate all that. If I'm going to trade, and I don't think there's a currency pair or price out there that you couldn't trade one full lot for $10,000, because the margin, I think the U.S. is going to be probably one of the more stringent margin requirements at 5% as a down payment. Now, you know, those rules could change. When you're watching this video, the U.S. may have a 15% margin. The stock market requires 50% margin. You know, that could very well change. But right now, take advantage of it because it's 5%. So if the price is $1.3000, $130,000, 5% of that is $6,500. So I've got to have at least $6,500 to open the position. Now, if it goes under $6,500, I can still trade that because the broker is giving me 50-to-1 leverage or whatever it is. And so at that point, my margin call probably wouldn't happen until I only had $3,000 left in the account, or whatever it is. It's actually 2% of the 50-to-1 is 2% of the account. So 2% of 130,000 is 20. Yeah, about $3,000. You'd get a margin call. But if I lost from the $6,500, if my account dropped and I closed it out, and I only had $6,450, I could not reopen the trade for one full lot. So I need more runway. I need more dry powder than just $6,500 to go into that trade. So would it be safe to say I could go in at $6,800, $7,000, $8,000? What if the price was at 1.4265? Or what if the price was at 1.0328? Now you're doing position sizing calculations. I've got 10,000 bucks. I figure out what my margin should be, and it's always going to be under that $10,000 level. And so I just say, okay, my bank is $10,000. I'm going to trade one full lot. How much dry powder do I have? Well, in the case of 1.3000 on a GBP USD currency pair, at 5% of $130,000 is $6,500. From the 10,000 gives me $3,500 of runway. At $10 a pip, that's 350 pips of runway that I have. And if I lose 350 pips, I must have gone off to the bathroom to take an enormous dump to have it pin bar out 350 pips on me. And that's not unheard of to have happen. So, I mean, I've had prices that I've walked off and I've come back and they've been 200 pips against me. So you do have to be kind of careful there. And obviously, if the underlying value of that currency pair was 1.75, then your margin requirement might be $8,000, and so you'd only have $2,000 of runway. But the fact is that you'd have runway enough to trade with a lot of pip lossage giving you some slack. And the way I calculate my positions is, particularly when I'm starting out with just that base number, I haven't made any money. I say I'm going to trade one full lot. I put 10,000 bucks in my account and I'm going to trade that. Now, what I want to consider is that I'm going to lose 6 times in a row. And I don't know how many times I've done that because I'm an active trader. So the probability of me hitting 6 losers in a row, well, 6 winners in a row is equal to the 6 losers. But regardless of that, I want to make sure I've got enough dry powder to hit 6 losers in a row, and I'm still able to satisfy my, for example, $6,500 worth of margin. So my concern is my bank size. What's my bank size? I'm not position sizing, I'm bank sizing. And it makes my life a hell of a lot easier. So given the fact that I have $3,500 of dry powder, that means I would have to lose 350 pips to hit wood. So if I hit 6 losers in a row and I was trading at $10 a pip and I lost 100 pips each time, I'd be 6,000 bucks out, and I'd be so far underwater it would be unreasonable. So those 6 losses can't come if I'm trading long term and I'm setting 100 pip stop losses to make a 300, 3 to 1 on my risk, and I lose 6 times in a row. I can't do that. I could lose 3 times in a row, but that's not enough times of loss to account for the probabilities that you're going to face. And so I would never, with a $10,000 bank, trade long term where my exposure was $100 a pip. Well, what if it was $30 a pip? I could lose if I was a 30 pip stop loss, you multiply 30 times 6, and yeah, that's 180 times. You're in good shape. You're in good shape. So what is your stop going to be? Is it going to vary? If your stop is going to vary and you're going to say, well, I'm going to give it 30 pips this time, I'm going to give it 80 pips this time, I'm going to give it 10 pips this time, again, you're complicating your life. You do whatever you want to do. I'm a day trader, and I trade on a 5-minute time frame with an ATR. It happens to be around 5 pips. And when that ATR is around 5 pips, my entry stop is 8 pips. And so 6 times 8, 8 pips, I lose 48 pips. I lose $480 in my statistical losers. When I was trading with a $40,000 account, the $40,000 I lost, when I first started out trading that account in live time, I had I had a couple of winners in there, but I did hit those 6 losses right up front. And they were massive losses because I was following the guidelines that all the talking heads on videos talk about, reward to risk and blah, 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 blah. And you're safer if you trade long term, and you run for 200 pips and you're safe at taking a 200 pip loss or a 100 pip loss. You're in good shape. And I lost 6 times in a row, and I lost 12,000 bucks right off the top. So, and that was just the beginning of my demise. So I'm not a big fan of the long-term trading, because you do have to extend your. If you're trading long-term and you're shooting for 200 pips, you can't You can't set an 8 pip hard stop. You can't. You can't set a 20 pip hard stop. It's stupid. You have to be willing to take that longer view so that your price is moving. I'm in a trade right now. And it's a long-term deal because I'm trading based on a reversion to the mean event, and I've got to give it 40 or 50 pips. And so I'm underwater 10 pips right now on a $40,000 account, trading 4 lots. So there's a significant loss there, but that's okay because that isn't even that's about where my profit target is. So I'm 1-to-1 right now. I'm not worried about that. Now it may go $2,000 or $3,000 against me, and that's okay because I've accounted for that in the way that I've been trading recently. I don't just day trade. I can do some long-term trading, and I can apply the principles that I have in the short-term environment up into the longer time frames. But that's because I've a little more experienced at it maybe than you are. I've been looking at this stuff since 2007. But in teaching it or sharing what I do, where my rules come from, where my roots are, is I don't position size, I bank size. If I got $10,000 in my account, I'm going to trade 1 full lot. If I have $20,000 in my account, I could trade 2 full lots. But I could opt to trade 1 full lot. And then I'm not basing my wins and losses on a $20,000 account. I base it on the $10,000 that I have at risk, not the $20,000. And that just makes sense. I don't know what all these fools are talking about. When I was in real estate, I had multiple buildings. And if I had a major construction project that I had to do against that building, a repair or cleaning out a tenant's apartment, it was $2,000 or $3,000 that I had to come up with. I wasn't balancing the $2,000 or $3,000 against my whole portfolio. I was balancing against the P&L of that building. I mean, come on. And does anybody out there that's teaching this currency trading stuff have any clue as to what they're doing? I don't think so. If you're a hedge fund, this is where they're getting it. If you're a hedge fund and you're reporting your balances, they're doing compounding, and they are basing all their wins and losses not on the individual trades that they're making, but on the balance of the portfolio, because they've got 60 or 70% of that portfolio invested all the time, and the rest is sitting there as dry powder. So it works all together in total harmony. If somebody said to me, gee, how much, what percent did you make on that building that you just sold? Or would I base it on the purchase price of the building versus what I sold it for? Would I base it on the down payment that I made on the building? Yeah, probably. If I made $100,000 on the sale of the building and I put $10,000 down to buy the building, I made a really good percentage return on my money. But if I had 10 buildings out there, I sold one and had the other 9, and there was $1 million worth of equity in those other buildings, or value in those other buildings, and I made $100,000 on this building, would I say that I'd only made 10% on my money? No, I made a lot more than that, because I based it on just the $10,000 that I put up for margin, or what they call in real estate down payment, right? Okay, so if you've got the bank size of $10,000 and 5% of that value is $6,500, and you've got $3,500 of runway, that's how you trade. Where do you set your stop now? Well, just make sure that you only use up about half your runway, or maybe a third of your runway. That's up to you. But 6 times some number equals half of $3,500, or a third of $3,500. So now you're starting to think about where your stop should be. I don't think about where my stop should be. It's 8 pips. Let's not get crazy with it. Because if one time I set it for 8 pips and I do that 10 times in a row and I'm making money, and then I go, oh, here's a long-term trade. I got to set it out at 80 pips, and because I'm going to shoot for 300 pips, and I got an 80 pip stop, and I lose the 80 pips. I've wiped out all the profits that I've made. You have to stay consistent. Risk is the biggest thing that you're concerned with, and if you're doing position sizing and compounding and all that other crap, you are not paying attention to what you need to pay attention to. So in the conversation that you may have with other traders or other educators, if they start talking about position sizing, ask them if they understand the difference between position sizing and bank sizing and why they're choosing position sizing to talk to you. I'm just saying. Peter Rose, Longwood Currency Trading. Hey, have a great day and have a great trading day.